Hey, what's going on, everybody? Welcome to Bonafide Investing, where we talk all things high yield investing, options, investment ideas, and really investment goals in general. If you're new to the channel, welcome. A little bit of background on what we're doing here. I have taken about 20% of my net worth. I have put it into a all-weather high yield portfolio that I call Cash Flow Life that seeks to pay my bills and maintain and pay down my margin over time. Please know nothing we discuss here is investment advice, not now, not ever. So please do your own due diligence before making any investment decisions. Though I was once a financial advisor, I'm not responsible for your wins. I'm not responsible for your losses. Please hit like and subscribe. Please help support the channel. Leave your comments, share and like. The more support I can get, the more videos we can make. What I want to talk about today, I want to talk a little bit about, can you really live off a high yield portfolio forever? I get this question a lot. As a matter of fact, over the weekend, had some good time with family and friends, got into some really good conversations. And that's really kind of what inspired this video today. I just want to talk about that and give you my thoughts on whether I think an investor truly can do it. Okay. So first off, just a little background. It's Monday. Markets are, what are they doing today? Markets are down. NASDAQ's down over 1%. S&P's down over 1%. So that means I'm probably going to dollar cost average, double this $200 amount that I do daily. And I'll probably do it back into QDTE, QLDY, QQQY, XDTE, and SPY. Since gold is having a good day, I won't be dollar cost averaging back into that. So I'll probably put it back into the indices since that is, having the worst day. Whenever we have down days of 1% or more, I want to double my dollar cost average for that day. But I'm going to wait till closer to market close today to see, if markets have rallied back or not. So can you really live off a high yield portfolio? And so again, I've been experimenting for a little bit over 2 years, or right around 2 years. We'll just call it 2 years. And what I found is I think you can, but I think there are, certain variables, certain things that you want to be mindful of. Okay. Now, again, my reason, my why, I talked about it last time. I want to, avoid the 9 to 5, spend more time with my kids, pursue hobbies and travel, right? Those are my main reasons why. I've never done this to become lazy and sit around and call it a day, right? No, I want to volunteer. I want to do things that, I'm passionate about and, really want to make me jump out of bed in the morning. Right. And everybody's different. I've got friends who have built high yield portfolios who love their jobs. They love what they do. And they, want the high yield just to have it, maybe to take extra vacations, to, buy some toys, whatever it might be. Just know why you're doing it. Okay. So I think the first thing you have to do right out of the gate is know your annual bills. Okay. You've got to know, okay, how much are my bills? And your bills are going to go up with inflation, right? So when you do, put down your bills, you're going to have some fixed costs, maybe like a fixed mortgage, right? Maybe a car payment that's fixed. You're going to have some fixed costs, but be mindful that cars need to be replaced. Things need to be replaced. Home maintenance is not that great, right? Chris Rock said it best. It's really home ownership at the end of the day instead of home ownership. There's a lot of truth behind that. Okay. So again, fixed mortgage, that's a huge help, but at the same time, your insurance costs are going to go up. Your property taxes are probably going to go up, and the cost to repair and fix it are probably going to go up over time, mostly due to inflation. So being mindful of those costs. So figure out your budget. Okay. I'm going to use just nice round numbers. My annual bills are about $118,000 per year. Cash Flow Life as of this last week was about $189,000, $190,000. Okay. That fluctuates. Okay. And that's another thing we want to be mindful of, that the income in your high yield portfolio will fluctuate. I have found with my holdings, I fall somewhere between 25 and 30%. I am sometimes making changes, right, outside of my core positions. Now, what I wouldn't do is, change too often, make too many buys and sells. Okay. You can trigger a lot of tax issues that way, number one. And number two, I think it's really hard to lock down at least somewhat of a consistent cash flow. And I'll give you an example. TLTW pays about 12% annualized. It's been about 9 to 10% lately, but months before that, it was about 18 to 20%. So it averages about 12%. Okay. Same with CRF. It averages about 17 to 18%. Okay. So I can rely on having those yields pretty close to where they are. QLDY, about 40%. Okay. But sometimes you might buy things that, pay a lot, like QDTE in December. At the end of the year, they distribute, hundreds of percents annualized, and then they really drop off January and February. Okay. Which is fine. But again, you want to be kind of mindful of what is my cash flow going to look like? Because, your bills for the most part are going to stay pretty set each and every month. Like I said, creeping slowly with inflation. So I like to tell investors that the 4% rule, in my opinion, is dead. If you really believe that we have, 2.5%, 3% inflation, good for you. I think we're closer to 10%. Anybody who buys groceries, anybody who just, I guess, lives life, right? I think would say inflation is grossly understated. So again, I like to adjust for 10% inflation, right? On average, inflation might be higher than that. It might be lower than that, but I think 10% is a safe number. And again, this is not growth. This is not a modern portfolio theory strategy. This is not something where we're buying and then selling shares to live off of, right, over time. And I don't like that. I don't like timing markets. I've said before, I'm a horrible market timer. I don't care to time markets. Okay. So with that said, what I want to do is, be mindful of just knowing I'm going to get my distributions early, often, and that's going to hinder the growth in the portfolio. So with that said, to truly live off of a high dividend portfolio, I think dollar cost averaging back into the strategy is rule number one. You have to do it. Okay. So if you're trying to live off it, and let's say your bills are $100,000 per year, we'll use easy numbers. You've got to generate $100,000 per year. I would argue you got to generate more. Okay. And since you're going to succumb to NAV erosion from high yield, what you want to do is you want to be just buying income every single day, I think, in a very diversified way. Okay. So I had a question, what's my reason for my high YQQ position? Well, I think markets are headed down. If I could be wrong, doesn't matter. I'll adjust accordingly. I'll sell some YQQQ if we push through current resistance, and I'll let the markets, find new price discovery. And I will hedge once I think that, we might be getting, a little long or a little expensive once we go up again. But I think we're falling. I don't know if it's the start of it. I've thought we were going to have the start of a correction many times. So who knows? I would not be surprised if we're down, 1.2%, 1%, whatever today. And then tomorrow we're up 1%. It's just kind of how it's been. And with that said, guys, sideways markets are a gift to high income investors. So markets will spend about 70% of their time going sideways. And that's the best environment for covered calls. Okay. So I think that's a good way you don't have to worry so much about NAV erosion, right? And you're going to get those distributions from that volatility, right? As it goes up. So as volatility increases, again, volatility is part of investing. As it goes up, your premiums will usually go up. But a sideways market is really a gift, right? Now, even some of the best yielders, let's pick on QQQI and SPY-I that yield about 12 to 14% between the two of them. They'll still succumb to some NAV erosion, right? They're not going to exactly match their respective indices. And that's just because they are selling covered calls. So they're going to miss a little bit of that upside, right? They've done really well to recover. If you think back to April 2025, when we were down about 20% pretty quickly. These ETFs recovered with the market pretty quick. But you had something like XDTE that does, 0 dates to expiration calls each and every day to generate higher income. That took longer to get back to its, previous price point. So again, you're going to trade yield for growth. Be very mindful of that, which is why I think you have to dollar cost average back into a diversified strategy. Number one. Another thing you can do that I've done is sell puts. Okay. You can sell puts on stocks or indices you would not mind owning to generate income for the portfolio, to build it quicker. I did that early on in Cash Flow Life. I'll still sell puts. I'll sell calls here and there. Lately, I just haven't seen the incentive, but it's something you can explore, okay, as you build your high yield portfolio. So sell puts, sell calls. Some of the ones I like are some of the 2x levered. There's like MSFU, for example, I have on Microsoft. Very, very, very low risk, right? To reward. I could control 100 shares of MSFU, and I bought it for around 170 bucks, right? The most I can lose is the premium I paid. No big deal. Okay. How much can I gain? Theoretically, infinite amounts. We know that stocks don't really go to infinity when they go up, but point is, as high as they'll go is what your potential reward can be. So this is where I think you want to be mindful of the charts, the data, the math. Find quality companies who have been, I think, beaten down and founded some support, and sell a put if you wouldn't mind owning it, generate some income, and that's one way to do it. So again, not financial advice, but just what I would do if I was building my high yield portfolio to keep it sustainable over time. Okay. You've also got to stay hedged. All right. Everybody hedges differently. I don't typically hedge with VXX calls, but my Q puts and my SPY puts are always on. Okay. And honestly, I don't think I'd even consider exercising these Qs and SPY puts till we had a 50% or more market crash. Okay. Again, that's what they're for, right? Thankfully, this current home I live in, I've lived in here about 11 years. It's never burned down, but I still pay my fire insurance just in case it does, right? So I don't want to be wiped out. And I think a lot of investors in their 20s and 30s just have not been humbled by the market yet. And I think when this crash comes, I think a lot of investors are going to get completely wiped out, thinking that bull markets just go on forever. They don't. Okay. So again, I want to have that insurance, and you should have an insurance on high yield portfolio, especially one that's paying your bills. Okay. A low cost way is to just buy puts. And another way you can do it is to buy like an inverse fund, like a YQQQ that tracks the NASDAQ inversely. So it will usually do opposite of what the NASDAQ's doing. And it's going to pay you each and every Friday as a hedge, which is nice. So YQQQ is more of my correction hedge, meaning if we get a 10, 20% sell off, great, right? If we get a crash, that's where my puts, my SPY puts and my Q puts kick in. If you want to do something like an ulti salty, again, these are paying about 60,000 per year. They're paying me a little over 1,000 a week right now. And it's basically covering my dollar cost averaging. Okay. So it's basically covering what I'm putting back into my diversified strategy. You see all these plus signs here, right? All the plus signs are my reinvestments that will be bought at some point today. Usually about the halfway point of the market being open. So I'm taking high yielding, right, ETFs that are basically more or less 1-to-1. I have a little bit more ulti than salty, but just gushing cash. I'm well aware of the NAV erosion, but then I'm putting that cash back into more stable ETFs. In my opinion, more quality ETFs. Okay. So again, I think you can live off a high yield portfolio, but I think you got to be very mindful of the areas I talked about. Dollar cost averaging, number one. Always buying income, right, to adjust for inflation and to offset some of that NAV erosion. You've got to be hedged, okay? However you do it. You can even hedge. I mean, I know a lot of people who don't want to buy the insurance. That's on them, whatever, or inverse funds. I also diversify through bonds. TLTW is a long treasury play. I like gold. I've told you guys before, gold is God's money. It's my favorite asset. Gold is another way. You got real estate, right? I bought a little bit of Exxon covered call exposure through XOMO. So there's ways to diversify. Don't diversify yourself so much to the point where you drive yourself crazy or I don't know, try to start timing things. I don't think that's a good reason, but diversification is key. And then the last thing is explore options. Options give you options. The old rumors that options are dangerous, I think, is terrible advice. Whoever started these rumors, options are actually safer, right? And the best example is this. If you want to buy Coca-Cola stock, you want to buy 100 shares and Coca-Cola is $71, you could sell a put for $70 and get paid to potentially then buy the shares at a lower price. So again, it lowers your cost basis, right? You get the premium up front. And then if you think that your stock that you hold might turn down, you can always sell calls on it and generate income off of it. If you wouldn't mind selling, right, at another price. So really consider even something basic like the wheel strategy where you sell a put. If you're assigned, you sell a call, it's called away, you repeat, right? It's just easy, simple wheel. I think that's a good thing to do also. Love to hear your thoughts and comments, what you're doing. Again, just to kind of give you my thoughts on this week, I said it yesterday. or on Saturday, excuse me, that I think we're headed down this week, but I was wrong last week. We shall see. I would not be surprised if these markets do start testing their resistance levels. That wouldn't surprise me at all. But again, on days where my puts are down, which is not today, and YQQ is down, which is not today, those are good days. But it's nice being up about 1% when the market's down about 1%. So again, not a perma bear, not a perma bull. You've got to adjust with market conditions. I would not ever succumb to all or nothing mindset when it comes to being a high yield investor. But again, trust God, right? Rely on the math and charts, ignore the noise, ignore the bankers and politicians. And please hit like and subscribe. Please share your comments. Hope you got something from today. Have a great day.